President Trump wrapped up the Japan leg of his Asian tour today, where he announced a trade deal after meeting with the country's new prime minister. Under the new agreement, the U.S. will impose a 15% tariff on nearly all Japanese imports.
President Trump wrapped up his stop in Japan, announcing a new trade deal, new investments in the U.S. economy.
President Trump's been meeting Japan's Prime Minister Sanae Takaichi for talks on trade and security. The pair have already signed a framework deal on the supply of critical minerals and rare earth minerals.
President Trump Japan quietly held one of the world's largest reserves of U.S. government debt, a position long viewed as an expression of confidence in the American dollar and the stability of Washington's financial system. That confidence is now eroding. Under the leadership of Prime Minister Sanae Takaichi, Tokyo is executing a shift few global observers anticipated, a deliberate, strategic drawdown of Japan's exposure to U.S. treasuries. This is not a slow or symbolic move. It is a decisive effort to reassert economic sovereignty at a moment when the global financial order is under strain. The first signs emerged subtly in early 2025. Data from Japan's Ministry of Finance showed foreign bond sales exceeding $20 billion in a single month, an unusual, sharp reversal for a country that for years steadily accumulated U.S. assets. Initially, analysts dismissed the surge as routine volatility or internal rebalancing by large institutional investors. But specialists at major financial firms quickly recognized the anomaly. According to analysts at Goldman Sachs, the sale marked the first structural signal that Japan was no longer passively supporting U.S. debt markets. Behind the scenes, the government was preparing for a far more consequential pivot. The arrival of Prime Minister Takaichi accelerated the shift. Insiders cited by major financial publications reported that her administration aims to reduce Treasury holdings by tens of billions of dollars each year. This pace would steadily erode Japan's role as the United States' most reliable foreign creditor. The significance of this cannot be overstated. For decades, Washington viewed Japan as a stabilizing force within the vast ecosystem of global debt buyers, a partner whose steady purchases helped keep U.S. financing costs manageable. Few expected that relationship to change so dramatically. What forced the shift was not slow-moving economic analysis, but political confrontation. When the Trump administration imposed a new round of tariffs targeting Japan's automotive industry, citing alleged unfair trade practices, Tokyo interpreted the move as a warning. Senior Japanese officials convened emergency sessions to reassess their exposure. If Washington could weaponize trade policy with little notice, they reasoned, what assurance existed that financial policy would remain untouched? Former advisors to the Ministry of Finance later described this moment as a decisive break. The tariffs, they argued, made clear that U.S. treasuries could no longer be assumed safe purely because of historical precedent. From that point, treasury sales accelerated. International banks began referring to a Japan unwind, a phrase used to describe the systematic reduction of Japanese ownership of U.S. debt. As recently as early 2024, Japan's holdings exceeded $1 trillion. By mid-2025, data from U.S. analysts indicated a substantial decline, enough to raise questions about whether Japan would remain a dominant force in the market. If current trend persists over the next 2 years, Japan will no longer play a central role in supporting the U.S. bond market, a shift without modern precedent. Tokyo's reasoning is blunt and strategic. Within internal policy discussions, the phrase unacceptable dependence has surfaced repeatedly. A comprehensive review by Japan's National Financial Security Council advised reducing exposure to dollar-denominated assets and reallocating reserves toward gold, euros, pounds, and even China's yuan. Confidential reports warn that continued reliance on treasuries could become a national vulnerability if Washington used economic pressure or sanctions unpredictably. These concerns were reinforced by the global response to Russia's 2022 invasion of Ukraine, when the West froze Russian assets overnight, a chilling example for governments worldwide. The Bank of Japan has confirmed record growth in non-dollar reserve categories. While gold is described by key policymakers as insurance against political and financial unpredictability, major institutional investors are also expanding positions in European bonds. Corporations, for their part, are quietly shifting portions of their liquid assets from dollars into euros and Swiss francs, mindful of scenarios in which the United States could restrict foreign access to dollar-based financial channels. The consequences for global markets are already emerging. Declining demand from major foreign buyers means U.S. bond auctions are beginning to produce higher yields, reflecting rising borrowing costs for Washington. Japan drawdown compounds an ongoing trend initiated by China, which has reduced its Treasury position for years. With both of Asia's largest financial powers moving away from U.S. debt simultaneously, the cumulative pressure is unprecedented. Analysts at multiple research institutions note that even if diplomatic relations improve, Japan is unlikely to return to its previous levels of Treasury accumulation. The shift reflects not a temporary reaction, but a structural recalibration of national strategy, one that signals profound change in how Tokyo views the risks and responsibilities of its role in global finance. Tokyo's approach to U.S. debt is not designed as a hostile gesture toward Washington, but as a defensive strategy meant to shield Japan from the risk of economic coercion. This recalibration signals a profound shift in global finance. The long era in which Japanese banks, pension funds, and government institutions automatically supported U.S. treasuries is fading. For the first time in modern financial history, the United States can no longer assume unwavering loyalty from its largest foreign creditor. Japan's move also reflects a wider global trend. Nations that once appeared firm pillars of the dollar-based system are beginning to reconsider the risks of concentrated exposure. The IMF's Financial Stability Review highlights at least 10 major holders of U.S. government bonds, including South Korea, Singapore, Saudi Arabia, and several European central banks, that have been quietly reducing their dollar-denominated assets since late 2024. Publicly, these shifts are framed as routine portfolio optimization. Privately, analysts at major firms such as Morgan Stanley argue the motivation is more strategic, growing concern that Washington may increasingly use financial tools as instruments of geopolitical pressure. This caution is reinforced by structural changes occurring elsewhere. The BRICS bloc is investing heavily in alternative financial systems, including discussions around a unified digital currency, expanding settlement mechanisms outside dollar-based networks, and encouraging trade invoicing in regional currencies. Though none of these initiatives dismantles the dollar's dominance today, the trend is unmistakable: a gradual, deliberate diversification away from a single point of vulnerability. Against this backdrop, the traditional image of U.S. Treasuries as the world's safest and most predictable asset is beginning to shift. As more foreign holders trim their exposure, demand for American debt is no longer guaranteed. The timing is particularly challenging for Washington. U.S. federal debt is expanding at an unprecedented pace. Annual deficits run into the trillions, and interest payments on national obligations are nearing $1 trillion per year, higher than the defense budget. This financial backdrop magnifies the risk created by weakening foreign demand. What was once a stable and automatic global financing mechanism has become a structural vulnerability with no modern precedent. The effects are already visible in the bond market. Rising yields at U.S. Treasury auctions reveal the growing cost of borrowing as investors demand higher compensation for risk and reduce foreign participation. Analysts note that Japan's ongoing sales are exerting measurable upward pressure on yields, indicating that markets are responding not just to domestic economic conditions but to geopolitical shifts in creditor behavior. When combined with China's long-running reductions in Treasury holdings, the result is a dual shock. For decades, Washington relied on the implicit assumption that even if one major Asian creditor adjusted its holdings, the other will provide stabilizing support. That assumption no longer holds. Japan and China are stepping back simultaneously. What distinguishes Japan's strategy is its precision and deliberateness. This is not an emotional or retaliatory reaction. Tokyo's approach is methodical, incremental reductions in treasuries that avoid market chaos while steadily rebalancing national exposure. Increased acquisitions of gold, diversification into European and Asian bonds, and a gradual shift toward non-dollar reserves reflect a clear principle: financial security must not depend on the stability of a single currency or the political behavior of a single foreign government. The private sector is taking cues from this policy environment. Large corporations are converting portions of their dollar reserves into euros, Swiss francs, and even Chinese renminbi. Executive boards cite geopolitical risk, tariff unpredictability, and concerns about potential asset freezes, concerns informed by recent global precedents in which financial sanctions were deployed rapidly and without historical precedent. Each of these decisions, whether by government ministries or multinational corporations, reinforces a shared conclusion: deep reliance on U.S. debt represents a strategic vulnerability that must be addressed proactively. Japan's transformation offers a window into a broader global inflection point. Reductions in Treasury holdings are more than a technical adjustment. They represent a shift in the psychology of global capital, an erosion of the long-standing confidence that the U.S. debt market would always be backed by predictable, high-volume foreign demand. Nations that once viewed treasuries as untouchable now see potential exposure to political volatility, policy swings, and sanctions risk. As Japan continues to step away, more governments are quietly running the same calculations. Meanwhile, domestic pressures in the United States continue to mount. Record debt levels, persistent fiscal deficits, and rising interest costs are converging at a moment when foreign support is weakening. The U.S. government must now grapple with an increasingly urgent question. If Japan and China, the largest foreign holders of U.S. debt, both reduce their exposure, who will fill the gap? Domestic buyers may not be sufficient, and other foreign investors are no longer certain that the dollar offers absolute neutrality or protection from political shocks. The result is a potentially historic challenge, one that extends from financial markets to foreign policy and long-term economic planning. This shift marks the beginning of a new era. Confidence that was once assumed must now be actively sustained. Market stability can no longer rely on decades of habit or the expectation that global creditors will absorb unlimited amounts of U.S. debt. As Japan accelerates its strategic exit from treasuries, the world is witnessing the early stages of a structural realignment. Countries are reevaluating reserve compositions, diversifying currency exposure, and exploring alternatives to dollar-based trade channels. The United States, faced with rising borrowing costs and diminishing foreign demand, is entering unfamiliar territory. The combined impact of Japan's measured retreat, China's ongoing adjustments, and the broader international shift toward diversification is redefining the architecture of global finance. Systems built on the assumption of perpetual demand for U.S. debt are being reassessed.